The best way to improve your income statement is simply by negotiating a great deal. As far as the accounting goes, there are some choices you can make that will affect the timing of certain expenses. You can engineer your lease to give you greater profitability now and less later, or the opposite, more expense now and less in the future. Here's how to improve near-term profitability. An operating lease is significantly better than a finance lease. The reason is that an operating lease records rent on a straight-line basis, while a finance lease uses the value of the asset and liability to charge interest and amortization expense. The nature of that calculation is that it starts high and slowly burns down. Therefore, the expenses are highest at the beginning of the lease and lowest at the end of the lease. Let's go back to our lease example. Here's the operating lease, and if you look at the total expense, which is shown here, you can see that the amount is the same every year. Now let's look at the finance lease. Here's that same line with the expense total. Remember that this was an operating lease for the first 2 years, so let's look at the total rent expense starting in 2019, which is here. You can see that the expense starts high and slowly decreases. Good for late-term profitability, bad for the near term. Tenant improvements with longer useful lives will spread out the amortization expense. That can be achieved by the type of improvement or the length of the lease. Lower net base rent as a proportion of total gross rent. So if you're looking at 2 spaces to lease and they both had the same total gross rent, the one with higher expenses would have better near-term profitability. For later-term profitability, everything is flipped. Finance leases are better than operating leases. TIs with useful lives that are shorter than the lease are preferred, and leases with higher net base rent as a portion of total gross rent are better. Now a couple comments about EBITDA. In short, the more things you can capitalize, the better. The reason is that capitalized items have interest and amortization expense, which is below the EBITDA line. Therefore, a finance lease creates a much better result compared to an operating lease because instead of straight-line rent expense, it records asset and amortization expense. A TI allowance will create better results than a turnkey build-out, the reason being that the allowance reduces straight-line rent and creates a TI asset that is amortized. A gross lease will have a slightly better result than a triple net lease. In a gross lease, taxes and insurance are capitalized, but in a triple net lease, they are not.